Welcome to Week 7, Presentation 3. We already discussed the income statement and cash flow statement. Now we're going to finish our discussion on financial statements with the balance sheet. The balance sheet shows what the firm owns and how these assets are financed. It's called the balance sheet because it balances assets and liability and equity. There are two sides to the balance sheet: the asset side and the liabilities and equity side, and both of these need to be exactly equal. Assets are the firm's resources, while liabilities are the firm's debts. Stockholders' equity refers to the owner's interest in the company. Total assets must be equivalent to liabilities and stockholders' equity in order for the balance sheet to balance. Stockholders' equity is the value of common stock plus retained earnings. Retained earnings are generated from that income that's retained by the company and not paid back to stockholders in the form of dividends. Retained earnings are the property of stockholders, and stockholders are entitled to all of the profit, but much of the profit is retained by the company in order to maintain the operation and provide growth for the company. If you look at the formula, it's very simple. Assets equals liabilities plus shareholder equity. If you want a better understanding of shareholder equity, you can compare it to home ownership, something many of us have an understanding of. Say, for example, you have a $400,000 house. This is the value of your asset. You made a $50,000 down payment and borrowed $350,000 to buy that $400,000 house. You now have $50,000 in homeowner's equity and $350,000 in liability in order to finance that $400,000 house. Now, what if the value of the house decreases to $200,000? Your equity evaporates and becomes negative. You still owe $350,000 on the house, and the value of the house is now $200,000. Your equity is now negative $150,000. This can also occur in publicly traded companies as well. Retained earnings on the balance sheet can become negative. Assets on the balance sheet are listed in the order of liquidity. Current assets are listed first. Assets that are convertible into cash within 1 year or one operating cycle are considered current assets and are relatively liquid. Cash includes checks and amounts in checking accounts, and this is the most liquid of assets. Liquidity refers to the nearness of an asset to cash, and you can't get any closer to cash than cash itself. Marketable securities are short-term investments that are held in order to provide a return. These marketable securities can be converted into cash very quickly and therefore are very liquid. Accounts receivable are amounts due from customers on credit sales. Companies may extend 30 or 60-day payment terms to their customers and thus have to wait this period of time to collect their money. This is a form of short-term loans to customers or trade credit. Inventories are also considered current assets. However, some inventories are more liquid than others. This depends on the industry and the process. If it takes a month to turn raw material into finished goods, another month to sell the finished goods on credit, and 2 more months to collect cash from customers, the cycle from expenditure of cash to the collection of cash is 4 months. This might be shorter or longer depending on a lot of different factors. Many times inventories are not considered when accounting for current assets depending on their liquidity. Inventories include raw materials, work in process, or finished goods. Fixed or long-term assets are those that are held over 1 year or one operating cycle, whichever is longer. They can include tangible assets such as land, buildings, and machinery. Depreciation is the allocation of the cost of an asset over its life, and this is subtracted from the value of the asset, reducing the value of the asset on the balance sheet. It's added up over the life of the asset and accumulated into accumulated depreciation. Stocks and bonds held in other companies are also listed under long-term assets. They're not necessarily marketable securities, but longer-term investments. Intangible assets are things such as patents, copyrights, and trademarks. A patent is granted to the inventor of a product for a period of 20 years, and it means that the inventor has exclusive rights to that product. A copyright is the rights to a work produced by an author for the life of that author plus 70 years after the author passes away. A trademark is a distinctive name or symbol, and these trademarks never expire. On the liability side of the balance sheet, we have current liabilities, those obligations that are expected to be paid with current assets within 1 year. Payables are considered current liabilities as our short-term obligations created for the acquisition of goods and services. Consider wages payable. This is the amount of money that the company owes its workers and is considered a liability or debt. There's also unearned income, where the income is generated but a service or good is still due to the customer, and this is considered a liability. Payment collected in advance of a service rendered might be rent paid for 3 years on a warehouse that the company owns. Although the rent has been paid in advance, the company still owes a service to the renter. Long-term liabilities are those obligations due in a period exceeding 1 year. Bonds are an example of long-term liability. These are debt instruments that are issued and require interest payments to bondholders. Operational obligations are those arising from the operation of the business, such as pension obligations or post-retirement benefits. These are also long-term obligations due to the retirees of employees. Deferred taxes are also long-term obligations in that they have to be paid in the future. It's important that managers keep track of the financial health of their company. The balance sheet is crucial in understanding the financial position of the company at any given time. Thank you for joining me today.